Good afternoon, welcome everyone. Just going to give it a few minutes to allow all the attendees to join. Appreciate you giving me half an hour of your afternoon today. Hope everyone's keeping well. Sun is shining here in Norwich, blue sky for once, which is nice. I'll give it about 1 or 2 minutes, let all the attendees join in, and we'll get started. Those that are desperate, you've probably got just about enough time to go and make yourself a cup of tea. Approaching nearly 200 attendees, which is really good. Around 600 people that registered, which is really good. While I'm waiting, for those of you that don't know, my name's Alex. I've been a BDM now for about 8 years. Landbay, we're a buy-to-let only mortgage lender. We've been around since, I believe it was April 2014 we first opened our doors. We do buy-to-let only, so no residential owner occupied, no bridging, no commercial or semi-commercial, just buy-to-let. And over the course of the next half hour or so, I'll be covering the challenges that you're currently presented with as brokers, and I'm sure there'll be some landlords on this session as well with affordability at the moment. Give it about another minute and then we'll kick off. If you do have any questions, happy to answer questions at the end of the session. I could ask that you use the Q&A function rather than the chat function on your Zoom panel. So click the Q&A and you should be able to type in any question. I'll be whizzing through the slides as quick as I possibly can because we have already had more than 50 questions submitted before this session. So lots of you are looking to engage, which is great. Of course, I'm not going to be able to answer all of the questions. I'll pick a few of those out when I look at the Q&A at the end. If we don't answer your question, I'll provide my email and no doubt we'll be following up with you, and you can reach out to either myself or one of your BDMs at Landbay. Just had about another 40 join in the last 20 seconds. Got about another minute or so to grab yourself a drink before we kick off. Thank you to those that have just joined. Just give it another few seconds to allow any other participants to join in case they're having some technical difficulties. Okay, good. I think we'll kick off. Anyone who joins late, I'm sure they can just pick up midway through. So once again, thank you so much for joining. The expectation is that I'll be having you for around 30 to 40 minutes today. I'm hoping slides will probably take around 20 or so minutes to go through. Of course, it's a monologue, me talking at you, so normally I will go through the slides quite quickly. And then we'll have a Q&A at the end. As mentioned at the start, had around 50 questions already submitted, so the engagement level is excellent. If you do have any more questions that are either prompted through the slides or anything that comes to mind, please put it in the Q&A function. And if there's time at the end, I'll go through that as well as the questions that have been submitted in advance and try and answer those for you. So my name's Alex Witham. I'm a regional account manager for Landbay. I've been with Landbay now since December 2019. If you've not already worked out from my accent, I am a Norfolk boy, born and bred. Yes, I do support Norwich, but no questions on that, please. And we'll be covering buy-to-let affordability, navigating the challenges. I think this is probably the third spotlight session for Landbay. We get some really good engagement, so I'm sure there'll be others after this session. So the agenda will be talking about stress testing. I'll explain a little bit about what that is. There is a wide array of experience of participants, from brand new mortgage brokers who are yet to fully get qualified. On this session, 2 people who've been doing writing mortgages are probably longer than I've been on this earth. So I'll try and keep it fit for all participants. So some of you may feel this is Buy-to-Let 101. Hopefully this is a refresher for the majority of you. How to calculate affordability. You can calculate affordability manually using a normal calculator. You don't have to use a lender's calculator. A good chunk of you will know how to do that. Some won't. So I'll talk about how you can use a normal mental arithmetic or a calculator to work it out. I'll explore the changes that we've experienced in affordability, predominantly focusing on shortly before the PRA supervisory statement, which was released in 2016, came into effect in 2017. So I'll kind of talk about what affordability used to look like, how it's evolved, and what it looks like now. Obviously, the 2 or 3 things that are very pressing in buy-to-let is not only the kind of rate shock that people are experiencing, but the higher the rates are, stress testing is directly linked to that. And of course, product fees is something that you're all seeing, both high street and non-bank specialist and bank specialist. The product fees have increased lately. I'll explain why that is. I'll also cover the growth of a particular segment of the market, namely SPV, special purpose vehicle, kind of give you my views on what that looks like, why, where that's headed. Some challenges, I'll pick 3 or 4 common challenges that you'll face, portfolios not meeting, stress testing, income requirements, and so on, and kind of try and drill home how Landbay are trying to support our clients and brokers on those challenges. I'll dip my toe in our variable fee structure and explain why we're doing it, what it means for you, the difference that it makes on affordability and product option for the client, and kind of wrapping up with how to use Landbay's affordability calculator on our website. So that should kind of cover us for the next 15-20 minutes or so. So before I go over stress testing, a lot of the people that are participating will know I do enjoy LinkedIn. So do connect. My name's Alex Witham, spelt in front of you. Often gets spelt incorrectly. alex.witham@landbay.co.uk is my email. You can find me on LinkedIn. By all means, connect, follow, engage with any of the posts that I put on. Like I said, I'm based in Norwich. The areas that I cover on your screen, so based in NR, so of course I cover NR, PE, SG, SS, IP, CM, CBAL, CO, a wide array of postcodes. If you're in those particular areas, I am your BDM. If not, landbay.co.uk is our website, has the BDM finder, and you can find who your particular rep is covering your area. Okay, so getting straight into the meat of the presentation. So stress testing, so what is it? So, of course, in residential mortgages, income plays a significant part in what you can borrow. It's totally different in buy-to-let, as I'm sure you know. So unlike on a resi, we don't, and buy-to-let lenders typically don't consider your personal income when assessing the affordability for a buy-to-let. Some lenders will have entry-level income requirements. For example, you need to have £25,000 income to meet with a particular lender, 40,000 with others. If they're first-time landlords, the income requirements may be a little bit more strict. But in general, lenders don't look at your surplus income or your personal income when assessing if a buy-to-let is affordable. It's worked out totally different. So to calculate affordability, the rent needs to cover the mortgage interest-only payment at a set level. Now, that level varies, but it typically ranges between 125% to 145%. Some lenders will vary it depending on if you're a first-time landlord or if the property's a HMO or a multi-unit. But typically, you'll notice the ICRs range from between 125 to 145. And often, the tax banding of the individual is the driver as to whether it's the lower ICR or the higher end of the ICR. Now, essentially, lenders need to apply a stress test over and above 100% to ensure that there is coverage for things like voids, if the tenant was to cause damages, if there was routine maintenance, and also to pay things like taxes, management costs, and all of the other reams of expenditure that landlords have to account for. Of course, if a property is vacant for a period, there's a void, you would hope that if the rent is significantly more than the mortgage payment, landlords have been sandbagging and putting some cash back for a potential void. So lenders will apply an ICR over 100% to ensure that there's sufficient affordability to meet the costs of the landlord would incur. The rent usually needs to cover an assumed interest rate of typically 5.5%, but that can be higher, especially if you look at a 2-year deal, a tracker, a discounted deal. Often the assumed interest rate will be higher than 5.5%, which is what's driving a lot of customers and brokers to pick 5-year fixed rates, because they will usually, not always, stress at a lower level. Now, some lenders will stress as low as what's called pay rate. Now, pay rate or notional rate, all these kind of all this jargon essentially means the same thing. Pay rate is what is the interest rate of the product that you're looking at. If you're looking at a 5-year deal with Landbay, 4.79% fixed for 5 years, that would stress at 4.79. So some lenders will reduce the stress rate to as low as pay rate. It's very rare to see a lender stress lower than pay rate. I certainly don't know of any, but there may be people on this group, on this call that do know of some. Now, some of the lingo that you'll see, ICR, DSCR, notional rate, stress rate, pay rate, very much all mean the same thing. So if you are new on this call, perhaps you're a newer broker, don't get too confused. ICR stands for interest coverage rate. Debt service coverage rate is what DSCR is. They are two of the same things. Notional rate, stress rate, and pay rate also, it's all the same thing. So if a lender says our DSCR is 125%, stressed at a notional rate of 6%, the stress rate of that deal is 125 at 6%. So I mentioned at the start, you can calculate affordability yourself. You don't need to lean on a lender's affordability calculator on their website to determine how much, as an indication, the lender would give you. So if you have got pen and paper, great, because you can write this down if you don't know how to manually work it out. But I thought I'd put it in front of you on the screen. If you know what the rent is, you can divide the rent by the ICR, or debt service coverage rate, whatever the lender's referring it to. Let's use 125% as an example. You multiply that by 12. You divide that figure by the pay rate or notional rate or stressed rate. Let's use 4.79 as Landbay's example, and that would churn out what the max loan is. So if you have a normal calculator, you don't need to go to your preferred lender or Landbay's calculator or a quirky Excel spreadsheet. You can just do it using your iPhone, your Samsung, your mental arithmetic if you're that smart, and work it out yourself. There are two ways that I know of that you can calculate max loan. The first is using the rent. The second is if your client says to you, I want to borrow X amount of money, let's say they want to borrow 200,000, you can work it backwards. Loan amount divided by 12, multiplied by the ICR, and then multiply that by the pay rate, and that would give you the minimum rent amount that that property needs to achieve. Usually, when a client is inquiring, especially for a remortgage, they would know what the rent is. That's a known quantum. So if your client says, I'm currently with a particular lender, my tenant is paying £800 per month and I need to borrow X, you should be able to pretty quickly determine whether you can find a lender that would get close or a little bit more than what they're after, without needing to go through reams and reams and reams of lenders' affordability calculators. You could just work it out yourself. Now, a little crib sheet for you. You can use this, you can devise your own. I always find it quite useful having an indication as to what rent would equate to in borrowing terms. So in the words of Blue Peter, here's what I've done for you. This is a 5-year fix. So assuming an ICR of 125%, stressing at 4.79, for every £500 worth of rent a property would give, the loan would be 100,208. So if it was me and I was the broker and my customer said, I need to remortgage a property, the tenant is currently paying £1,000 per calendar month, right off the bat, I would know I can approximately get £200,000. Is that enough to meet their objectives? Yes or no? If it's not, then you would need to go through each individual lender's calculator and find out where it could possibly fit. But I feel it's quite useful for you to have an idea of roughly what perhaps high street would give, because usually they would be lower than what I've shown you on this screen, because this is land-based affordability, and then perhaps someone in specialist, so you can know, can I fit it with prime? If not, maybe it's a specialist lenders deal. Now, a 2-year fix will give you less borrowing. Lenders, we follow the PRA guidance. The PRA supervisory statement indicates on a 5-year deal, we have the ability to stress at the product pay rate. We don't have that luxury on a 2-year or tracker. So unfortunately, they are stressed not at pay rate. So a lot of lenders pick the product rate plus 2%. We are the same. So on the right here in the kind of teal green gives you the comparison that a 2-year fix with Landbay would give. So £500 worth of rent would give 70,000. 30k shy of what a 5-year fix would do. So perhaps as a little takeaway, spend 5 minutes using that calculation I gave you on the previous slide to create little crib sheets for yourself, and may save you a little bit of time using individual lenders' affordability calculators going forward. So how has affordability evolved? So typically, before the changes introduced with the supervisory statement, which more on that in a moment, lenders would typically calculate affordability with a widely used rate of 125% at 5% interest rate. Now, some were not quite so good, some were a little bit better, perhaps some high street prime were on the harsh end, and maybe the specialists were a little bit more flexible, but generally speaking, 125 at 5 was the widely used ICR pre-2017. And a key thing to bear in mind is there was no regulatory requirement to assess or apply any form of stress to a background portfolio. So background portfolios were largely left unchecked. You could have had a client, 5, 10 years ago, or 6, 7, 8, 10 years ago, who had a portfolio of 25, 30, 50 properties. A good chunk of lenders would say that was ring fenced, and they would just be looking at the new deal that you're bringing to that lender. That changed when the supervisory statement was introduced back in 2017, so around 6 years ago now. Also pre-2017, mortgage interest and some other allowable expenditure was also tax deductible. So there were some big changes coming as a result of, I think it was George Osborne at the time in his 2015 budget announced that there needs to be a change. Landlords have got it a bit too easy, and he therefore introduced what we now know as Section 24. And again, we can talk about that very briefly in a moment. But what essentially happened is a combination of factors. Yes, a combination of Mr. Osborne's reform, Section 24, also concerns of interest rates being quite low. They needed to, or lenders needed to have a cautionary view on what would happen if interest rates were to increase. So the supervisory statement was released, and in there it gave an update or a complete overhaul really to underwriting standards. And if you want to read that document, it's not particularly long or onerous. It's 5 or 6 pages long. It's called the Supervisory Statement, shortened to SS 13-16. So if you do wish to read a little bit more about what the PRA are instructing lenders to do and how lenders are interpreting that and bringing it into our own policy and procedures, have a read of that document. Because some of the things that we're doing or having to do and the constrictions that we're working with are very much prescribed in there. So like I mentioned, concerns of rate rises and the upcoming Section 24 tax changes were contributory factors of an overhaul in underwriting standards and ultimately affordability. And what happened was that these changes ultimately caused a surge of activity in 2016, early part of 2017. Brokers were informing their landlord clients. Big landlord clients were obviously watching things like the budget. They were looking at upcoming changes. They were trying to get ahead of the game, and there was a massive surge of activity in the buy-to-let market around kind of 6 years ago from now, really, because the changes, the underwriting changes, the stress testing changes were all introduced starting in January of 2017. And then some portfolio underwriting changes were later in 2017. So landlords were trying to get ahead of that curve, which may be why you guys saw, and certainly lenders saw, a hive of activity for refinancing, now and also throughout last year, because people were coming off those 5-year fixed deals, and having to look at reevaluating their portfolio and where do they go from here. So that moves on to how has it evolved? What are we like now? So affordability now, stress testing is vastly different. Each individual lender will have their own rules. You may find some high street lenders are very much aware of what the PRA will allow them to do, but they are choosing to stress products a little bit higher than perhaps what they could. That's down to their own risk and the volumes that they want. On the other end, you could have some lenders interpreting things slightly different. You could have some lenders having quite high risk, therefore charging slightly higher interest rates and doing things like pound for pound. But what's absolutely key here is your expertise, broker expertise, is needed way more now than it was, back in the day, because a client trying to navigate the raft of affordability, the nuances that lenders have in their criteria, little things that could trip people up, brokers are absolutely needed. So this is a market segment that you guys will thrive off. However, of course, it is challenging at the moment. Interest rates have increased. There's been a lot of pressure on borrowing capacity, put a lot of pressure on squeezing yields. Possibly smaller landlords are looking at, what do I do? Do I incorporate? Do I cash my chips in? Do I sell? That's really down to the individual, I guess, to decide what's right for them. But of course, ICRs vary now based on someone's tax status. That was something that was introduced in the supervisory statement. Lenders need to make sure they're considering people's costs and their taxes when looking at stress testing. So therefore, generally speaking, lower rate taxpayers are stressed at 125%. Higher rate taxpayers are stressed harsher at 145. The increase in stress test is to allow for the extra costs that private landlords have now got to navigate, because of course Section 24 has made their tax bill tremendously higher than it once was. The stress test needs to factor in the extra costs that those landlords have got to account for. Many of the questions in the Q&A was, why are higher rate taxpayers treated much worse than lower rate taxpayers? And ultimately, it's because of the Section 24 reform that came out in 2017 over a 4-year period. If you want to go through it in a bit more detail, then chuck a question in and we'll go through that at the end, or you've got my email address, or reach out to me. Also, post 2017, because of this supervisory statement, it's prescribed that our background portfolios need to be checked. So we're needing to look at how many properties as a landlord got, what's the rent that's being received. Some lenders are going deep enough to say things like, let's look at their savings for void periods. What assets have they got? Let's have a look at their other liabilities. It's a deep dive now compared to what it once was. And of course, that makes things a little bit more challenging for you and your clients. Some lenders can look at top slicing. Now, Landbay, one of the questions was, does Landbay allow top slicing? We do not certainly currently allow top slicing. We have been looking at a variety of things, but top slicing is kind of on the back burner at the moment. Bringing that in would require quite an upheaval with underwriting. We'd need to do full belt and braces, income expenditure dependent assessments, much like a residential mortgage lender does for an owner-occupied deal. But that's not one for Landbay at the moment. And post 2017, no doubt the experienced brokers on this call participating today will realize most people are picking 5-year fixed rate options to kind of ring fence themselves from short-term pain, and also benefit from being stressed at a much more generous rate, often pay rate, with lenders like Landbay. Now, one thing not to discount is SPVs, so limited company, special purpose vehicles, generally offer greater affordability. They certainly would with Landbay. If you had an individual who was a higher rate taxpayer, we would be stressing that client at 145%, as much other lenders would do the same. For limited companies, because the tax treatment is different in a company vehicle, because you can offset your costs, your mortgage interest still, we are stressing those lower at 125%. So if you have two wealthy individuals and they're looking to purchase buy-to-lets for the very first time, obviously SPVs could offer great affordability for them. So that's worth considering. Again, drilling home for the second time, broker expertise needed now more than ever. It's much, much more difficult navigating the buy-to-let arena as a landlord now. So going direct to lender, of course, is still an option, but brokers are definitely worth their weight in gold when it comes to buy-to-let. So looking at the growth of SPVs, so some data from Hamptons I found very, very interesting. Now, on the left of this graph, in 2007, 2008, that's showing you how many SPVs were set up in that period. So year on year, the graph is showing you the amount of SPVs created in that previous year. So in 2007, around 5,000 to 6,000 SPVs were set up. It receded the previous year in 2008. Those of you that can remember back then, of course, the economic crash happened in that time. I would imagine lots of things receded in 2008. So less SPVs were set up in that year. But you can see from a period of 07 to kind of 2014, it's a very steady increase, very, very, very steady and incremental. The budget happened in 2015, and then after then, the tax regime changes and Section 24 was introduced, and SPVs have just absolutely rocketed, and I mean rocketed. So in 2021, there were 47,000 SPVs set up. That's almost double from 5 years prior, and almost tenfold what it was in 2007. And it's still climbing because there was 48,790 SPVs set up last year. Not sure what's going to happen this year as of yet, but looking at that trajectory, SPVs very much seem to be the in thing when it comes to buy to let. We see lots of incorporations at Landbay, and quite a lot of the new purchasers that we're seeing, of course, depending on the advice they get from their tax consultant, we do see a lot of new purchasers being in an SPV, but of course you'll have your own view on what you see. So in total in the market, there's 309,000 SPVs as of the end of December of 2022. So if you're on this session thinking you don't do much limited company buy-to-let, I assume you're on this session because you do a lot of buy-to-let, because this is a buy-to-let session. If you don't do a lot of limited company buy-to-let, it's only a matter of time, because as you can see from this graph, the volume of SPVs has increased incredibly over a very, very condensed period of time. But I'm sure a lot of you have seen SPVs grow in volume. So what challenges are you facing? There'll be many. I've picked 4 to kind of discuss what you may be experiencing and trying to show you how Landbay may be able to help support you. If you're not already registered or doing business with Landbay, I would absolutely encourage you to register. If you just go to our website, top right-hand side, click the register button, fill in the form, you'll have immediate access. It will also mean you'll get regular updates for our criteria as and when that evolves, perhaps new products and exciting changes on how we look at portfolio landlords and so on. It's well worth registering if you're not already. So portfolio criteria can be difficult. Some lenders will have restrictions such as maximum LTV on the background portfolio, or the portfolio is stressed at 125 at 5.5, or maybe even harsher than that, or the maximum number of properties is 4 or 10. There'll be loads and rafts of criteria for you to navigate on, portfolio criteria. At Landbay, we have no background loan to value, so you could have a fairly highly geared portfolio landlord. That would be acceptable to Landbay, providing it passes a stress test, which we've chosen of 125% ICR at 5% interest rate. As a BDM, my job is to deal with 30, 40, 50 inquiries a day. Very rarely do I find our portfolio background criteria cause an issue. A stress test at 125% at 5% coverage is particularly light, and I'm sure most of you would agree. We've got no maximum number of properties or limitations of debt. So you could have a client who has a portfolio of 2, 5, 500 properties. They could be with 30 different lenders. It would be irrelevant. Absolutely fine for Landbay. So we're very well geared for larger portfolio landlords. When it comes to stress testing, all of our 5-year fixed deals are stressed at the product pay rate. And I'll explain on the next slide what those look like. It's between 4.29%. Yes, you heard that correct. So we could stress 125% at 4.29, which is a phenomenal stress rate. Right the way up to a standard buy to let 5-year fixed at 5.34 with varying fees, which I'll come on to in a moment. All of our 5-year fixeds are at the product pay rate. Base rate and limited companies are stressed at 125%. A big niche of ours is we go off individuals' declared income. So if you have an individual who has 30,000 of salary and they declare 20,000 of rent after their costs, but they're getting 50,000 of turnover of rent, which should push them into the higher rate tax category for some lenders. It doesn't with Landbay. We look at their declared income, and if they're base rate declared, we would stress that at 125%. When it comes to income, there are no minimum income for experienced landlords with Landbay. Some high street lenders may have a 25,000, 40,000, some specialists are the same. But if you have an experienced landlord on your hands, we have no minimum income. We do want to see the income that they have on their payslips and tax returns, and it all needs to make sense. So if you have somebody who is earning a lot of money, but there's no paper trail and they're clearly not declaring their tax, that would present, of course, a massive risk, and we wouldn't be interested in that deal. If you get anything quirky, just ring your BDM. We are happy with professional landlords. So if your client is retired or they are just full swing in property, they have no other PAYE or self-employed income, that is fine. For landlords with less than 2 years experience, the application, not individual, the application needs to have 25,000 of income. So if me and my wife wanted to apply for a buy-to-let with Landbay, and we were both first-time landlords, as long as I was earning 12,500 and my wife was earning 12,500, that would meet our requirements. It's not 25,000 per person. Now, when it comes to deposits, landlords do try and get creative sometimes. We're very aware of that. Intercompany loans are fine. So if we're lending to an SPV that is owned in part or full by a holding company, and said holding company wishes to loan the deposit money to the SPV, that would be perfectly acceptable. As long as there's some commonality between the two companies, it's one that we can consider. It doesn't need to be intercompany. It could just be somebody's trading business, has nothing to do with their SPV, wishes to use its cash in bank as the deposit. That would also be acceptable, providing there's commonality. Family gifts, as long as they're close family, mother, father, brother, sister, grandparent, that would be acceptable. Interfamily sales are fine. So if I now want to buy a portfolio off my mother, maybe she's buying a boat and going to sail the seas on her own, and she wishes to just get out of being a landlord, I could acquire her portfolio with none of my own cash. We would take her equity, if you like, as a gift, and that could fund the entirety of the transaction. So we are busy. We are doing good volume at the moment, very, very healthy volume. Market sentiments are a bit tempestuous. We understand that. However, a combination of these features that I've just mentioned, as well as our rates and stress testing, we are still seeing a lot of business. Notwithstanding, it's more difficult now than it was 6-12 months ago when rates were luxurious in the sub 3% category. So when it comes to the fees, I'm sure a number of you on this session are well aware of Landbay's fees, and to be honest, most lenders have increased their fees to compensate the more expensive rate environment that we're in at the moment. Essentially, what we're having to do is try and find a way to innovate, but ensure that we are still able to commercially exist and make our products commercially viable for us. At the end of the day, we're a business. We need to make sure we're offering products that work for the client, but they also keep us afloat and make sure that it works for both parties. We have got 17 different 5-year fixed rate products. Fees on our products range from £1,495 right the way up to 7%. The higher the product fee, the lower the APR. So what we're trying to do is we were one of the first to innovate the variable fee structure proposition. We're offering products which have the lowest possible APR, frankly, we can get away with offering to still make it viable, but we're needing to increase the product fee to ensure it's a profitable product for Landbay. Please don't think if we are doing a 7% product fee deal to your client over a 2%, it means Landbay are making so much more money than on a 2% deal. Essentially, it's cost neutral to us. So I'll give you an example. If we provide a 7% product fee product to the client, which is at 4.29%, it will stress at 4.29%. There's not a great deal of margin on the interest rate. If we were to do a 2% product fee deal, it's 1% higher on APR than the 7% product. So in effect, it's cost neutral to Landbay because it's 4.29 of a 7% fee or 5.29 of a 2% fee. It's 1% per year different lumped onto the product fee instead of the APR. So yes, we have product fees that have 3, 4, 5, 6, 7% product fee, but the APR is commensurate with the fee. So the lower the interest rate we can possibly offer just means you guys and the clients get a higher borrowing capacity out of that product. As I mentioned, the lower the fee, the higher the APR, the higher the APR, the lower the affordability. So we were trying to figure out a way to ensure that stress testing was working. The market sentiments when rates shot up around October, November time was no deal is going to fit. It's going to have to be a product transfer. No one's going to be able to capital raise or borrow more money or even pay off their existing lender if there's no PT option. This was a way that we ensured that we are offering solutions to those clients. Showing you what that means in pounds and pence is in front of you now. So on a 4.34% product that stresses at pay rate, there's a 7% product fee. The loan that would offer on a £1,000 per month rent on a 125 ICR would be 221. On the 5.34% product, which has a 2% product fee, it would be 179. So there's a £41,000 difference between those two products. So I'll give you an example. Let's say you've got a client who is getting divorced and they need to reach settlement. Maybe you've got a client on a bridging loan or a development loan or a mezz finance, or maybe they just need cash for capital raising or a new business venture. Sometimes the client wants the cash and they want the affordability. We can provide that option. If you have a client who does not have the desire for the borrowing capacity, they're looking more at the product fee, we have an option for them. So we believe that we've got 17 products that appeal to any type of client, because stressing at 434 is going to give you a much better borrowing than stressing at 534, but at the cost of a product fee. And that's how we still commercially exist. Using our calculator, very slick, very intuitive, very easy. Go to landbay.co.uk, click products and calculator, find the product that you're looking at, hit calculate, and it does all the work for you. But as I mentioned to you at the start, if you've just got a pen and paper and a calculator yourself, you don't need to use Landbay's affordability calculator. You could get a general feel for, is it going to fit, is it not, based on what you now understand from manually calculating it yourself. So in this scenario, just over 1,000 rent on this product would give a max net loan of 187, and they could add the £5,625 product fee to the loan. You can start a dip from our calculator. It's very, very slick. But as always, if you have any questions about using Landbay, what packaging we need, what product would work, or you wish to discuss a case in more detail, reach out to us and we'll let you know. So giving you an example of affordability in comparison to a lender, won't tell you who this lender is, versus Landbay, I thought I'd demonstrate that on this slide. So a 5-year fix with this particular lender at 75%, assuming that individual is a high rate taxpayer, where they're stressing at their product rate plus 1%, would give a max loan of 134. This was a high street lender. Of course, they may have nuances and criteria and things like that. But if this was a new to that lender customer, they would be stressing that deal at 145 at 6.14. Now, using the exact same situation, higher rate taxpayer, £1,000 rent, Landbay would be stressing that at 140%, so slightly less, at pay rate, which is 4.79, and that would give a loan of 178,000. So right off the bat there, you can see one of the comparisons between a lender versus Landbay. We are absolutely offering phenomenal affordability and providing excellent solutions to clients, of course, at the cost of the product fee. So that's always a key consideration. At the end of the day, you are the brokers, you are advising the client, sit them down, talk it through. If you know their motivation is the borrowing, we can provide you that option. To give you an example, if this was a limited company case, it would be just a little bit over 200,000. So limited company for affordability is stronger than that of personal buy-to-lets for higher rate taxpayers. Now, that is around 20-25 minutes of the slides. I really do hope that you've learned a little bit about Landbay, how we're supporting our landlord clients, what we have to offer. There are loads of questions that have come in. I have 9 on the Q&A, and I've got over 50 questions submitted in advance. So let me just stop the share, open the Q&A, and go through some of these. So Fergus, ICR, interest coverage ratio. So ICR is if the mortgage was interest only at £500 per month and the lender's ICR was 100%, it would mean the rent needs to be £500, exactly the same as the mortgage payment. So ICR, that's what that refers to. DSCR, debt service coverage rate, is the same. Will Landbay be introducing a product transfer facility in the future? Great question. We are very actively looking at product transfers at the moment. If you have an existing Landbay customer who's coming to the end of the deal, I would encourage that you call your BDM and we can work out whether we could offer perhaps an incentive to retain that customer before we possibly look at launching product transfers. Without going through the nuts and bolts of it, it's very difficult logistically to launch a product transfer proposition as it depends how the original loan was funded versus now. Are your mortgages for limited companies portable? No. So Zach, sorry, all mortgages with Landbay are not portable. Will Landbay look to use top slicing, says Ryan, from the applicant's non-property income? We do not currently look at top slicing. So unfortunately, that's not one for us. We have considered it, and we do continue to monitor whether that would work for us. However, currently, it's not one that we're looking at. Can you give us an update on your offer letter issues at this time? I understand this is due to reversion rate that's being pulled through onto the offer letter. So Robin, speak to us about that. That was a temporary glitch with only a select amount of offers affecting a small amount of customers, where the reversion rate just needs to be rejigged. So speak to your BDM about that, as it's a very, very isolated issue. Padraig, yes, I'll be sharing some slides after. This will also be recorded and available, I think, on YouTube and probably our website as well. So thank you for your feedback. Anonymous says, can I use money in my personal account to use as a deposit for my SPV? So yes, you can. Using your money in your personal bank account to fund your deposit for an SPV would just be recorded as a director's loan. So if I had 50k in my Halifax current account and I wanted to buy a buy-to-let and I needed £50,000 worth of deposit, I could issue that to my SPV as a director's loan, which you could then draw from at a later stage if you wish. How do you think it's fair on the customer to have to pay 7% fee? So as I explained earlier, at the end of the day, we need to make sure that we're offering a solution that can work for the client. Yes, a 7% fee is heavy. Customers are going to, not particularly enjoy paying a 7% product fee, but if they need the borrowing, that's how it's presented. That's how it's commercially viable for Landbay. Like I said, we could offer a 2% product fee deal, which is 1% per annum higher on the rate, but that would kill the stress testing. So it's got to work both ways. If we are short on a REMO, says Richard, could you take on the new loan and allow a shortfall on a second charge? We don't allow second charges, unfortunately. Good question. We do not consent to second charges. Nissar, do you accept let to buys? Let to buys, if it's for a landlord with no other buy-to-let at all, so just this current one they want to turn into a let-to-buy, no, we wouldn't do that unless they are moving it into an SPV. In our eyes, that would get round the regulatory requirements as it's a sale and purchase. So we can only do a let-to-buy for either experienced landlords, and if they're moving it into a limited company is another way we can look at it. But call your BDM if you've got an example and we can go through those. Loads of you asking for copies of the slides. Yes, we can provide copies of the slides either on the recording. Anne-Marie, portfolio lending, loan per property or one loan. So we don't do a portfolio loan as in one facility with multiple properties on that. It would be individual loans per property. We have considered that before. It makes it quite difficult when people start selling properties piecemeal and redeeming. So we would just look to do individual loans per property. You can duplicate with Landbay. So if you key one, click duplicate, it's very, very, very slick, very easy for you to administer. Are multi-unit freehold blocks acceptable? Yes, up to 12 units. If they're more than that, it's worth ringing your BDM. We might take a view. So 12 units on an MUFB. Do you accept non-owner occupiers? Yes, we accept non-owner occupiers as long as they are an experienced landlord. So doing that's for you. Can we use this session for CPD? Yes, you can. You probably need to speak to your network or something about getting a CPD certificate. But again, if you email me or us, then if you need something in writing, I'm happy to send you something. Taj, any 80% LTV lending? No 80% LTV lending. 75% is the max. We used to do 80, and 75% is where we're at the moment. Lots of other questions. There's 10 more to answer. 50 odd that were sent in advance. Let me just go to the ones that were sent before the session. Richard Granger, please explain the reasons for the different ICRs for different borrower types, i.e. SPV, individuals, as well as different tax positioning. So as I mentioned earlier, ultimately, if you own a buy-to-let in your personal name, Section 24 has hit you and affected your costs. So we need to make sure that landlords factor that in when they're doing their mathematics. So if you're a lower rate taxpayer, it's stressed at 125%. You only need 25% over the mortgage payment as your buffer. If you're a higher rate taxpayer, you need a 45% buffer because you've got a much larger tax bill. For limited companies, we would stress it lower, so they're 125%, because in a company name, your costs, your finance costs are still deductible in the main, whereas in private name, you only can claim a basic rate tax relief. Please don't take any of what I'm saying as actual tax accounting advice. You still need to get good tax advice, but that's my understanding of the rules. Penny has just said stress tests with written at the end. Yes, it is difficult for you. Hopefully you've learned over the last 40 minutes or so how Landbay may be able to support you placing your business. Ashley says, when will stress tests start returning to where they were 6 months ago? It's linked to the product. So the lower the interest rates go, the better the stress testing. I would love to stand here or sit here and say to you that stress testing is going to be 100% at 3% tomorrow. If we did that, we would fall over within a couple of days with volume. So we've got to, keep a glance on risk versus volume as well. Mahmood says, with more professional landlords moving into a limited company structure, how are you supporting them? Well, when it comes to limited company, we can lend to an SPV, trading business. We could lend to a layered company. We can take intercompany loans. We could, obviously the stress rate is better because they're stressed at 125%, whereas if it's private and higher rates, 145. So hopefully you've learned a little on how we can help for those. Let's pick a few others. Sunny, can you use their actual rent instead of market rent? So we would always go off the lower of what they're receiving or the market rent. So if they're receiving 2,000, but the valuer says it should be 1,750, we would base our stress testing on 1,750, not what they're receiving. Can you do first-time buyer, first-time landlords? No. Can you do buy-to-let for expats? No, unfortunately not. That is Farouk. How are lenders able to charge such high product fees? From Adam, there's a few of you asking about the product fees. Hopefully I've explained that. And just the last one here, how do you deal with valuers downvaluing properties on the rent or capital value? That's from John. There is an appeal process. Speak to the underwriter or your BDM, and we can send you the appeal process. And lastly, Taj, discount for EPC A, B, or C properties. We used to have a green range. We don't currently, however, we may well launch another green range very soon, which will knock about 0.05 or 0.1 off the interest rate. There are loads more questions. I'm very sorry I'm not going to be able to answer any more. There's still around 60 questions left to answer in total. If you have more questions, please reach out to us or your BDM. Go to landbay.co.uk's website. You can use the BDM finder or just call head office. I really appreciate your time. Thank you so much for joining, and enjoy the rest of your afternoon. Cheerio.